Okay. Very important video that nobody wants to fucking talk about, but I will because I think it's important, and it is related to crypto and financial markets. Private credit under pressure, defaults, redemptions, and the AI shock. So if you don't already know, we're going through a bit of a private credit crisis currently, all during a war, right? See, this could be a contagion for a massive financial collapse, potentially. I'm not saying it is, I'm not saying that it's not. I think it is personally, but I want to show you what I'm thinking, alright? Because this is very important. This can set off a financial collapse, a massive financial market crash. It is possible. Alright. A recent string of defaults by companies at least partially funded by private credit has raised investor concerns that more bad news may be lurking in the space. So basically with private credit, what they do is they use the money, investors' money, to fund businesses, to help grow businesses. So it's a bit more riskier than like a treasury bill or a T-bond, but you get more return, right? Say you get maybe 4% on a bond, you're getting about 6.5% on private credit, with a bit more risk. See, private credit is illiquid. You see, BlackRock and State Street, they've been blocking withdrawals from these private equity funds. You see, that's not a good sign. That's not a good sign. You know, and there's been a bit of a sell-off with the private equity space. So this could be a contagion for the financial reset potentially, because as it says here in the Dodd-Frank Act, it says a growing share of corporate credit has been extended to companies by entities outside of the traditional U.S. banking system than by those within. Alright, I'm going to tell you what that means, right? So with private equity, alright, when they had the Dodd-Frank Act, banks weren't able to leverage as much money as they could previously, right? So they had to restrict their lending. They can't lend out as much money as they once did, alright? So to compensate for the lack of lending, private equity was giving out more loans to compensate for that. And private credit, it's connected. It's very closely interconnected with the banking system. Because as usual, the corrupt banks, they don't want to lose money, right? They talk about the default risk, and also AI has is increasing the credit risk, because a lot of these software companies, they can't compensate. They're actually losing business because of AI. AI is taking dominance over their business model. It's making their business model irrelevant, you see, which puts further stress on the financial system. We're going to talk about that later on. I'm just trying to break down the sweet points for you, so you don't have to be here for 2 hours listening to me talk. Here's another company, Blue Owl. Anxiety rattles $1.8 trillion private credit market. Despite years of solid returns, direct lenders can't shake concerns about the once niche corner of global finance. And this company's shares took a bit of a hit, you know. Has been selling off. And same with BlackRock and there we go, BlackRock. This is one of the biggest fund managers in the world, and even they're limiting withdrawals to private credit. So it's multiple investment funds that are restricting withdrawals, and then they got to sell these assets at a loss. Another one, Blackstone, also, they've limited the redemption to 5%. So these investors can't get their money out, or it's very hard to get their money out. Let me see if I can find. Come on, man. So Fitch flags AI-driven credit risk in technology, media, and cloud sectors. So AI is really, it's reshaping the business world, you see. So those software companies, some of them they're gonna die off. They're gonna die off, which increases the default rates on private credit. This affects financial markets. If they don't adapt, they don't change their business model, the business is gonna die. So this is part of the AI risk, and the fact that these communists have overinvested in AI infrastructure that didn't help things either. These morons overinvested in AI. They should have done is progressively invested in it now, but now they wanted to get rich overnight, dump trillions of dollars, billions of dollars. Microsoft and Meta just dumping money left, right, and center into AI. It even says right here, AI-driven capital expenditure (capex) boom is primarily concentrated among a handful of hyperscalers and cloud service providers. Big four right there. Alphabet, Microsoft, Amazon, and Meta plan to spend roughly $650 billion in 2026 on AI-related infrastructure, nearly matching cumulative spending from 2020 to 2024. That does not help. That does not help with the financial system. So this increases the risk of where's the other one? So I spoke about oh my god, it's so irritating doing this shit. Very sorry, guys. Private credit fund is selling $477 million of assets at 94% value as industry worries continue. Not good. Not good. New Mountain Private Credit Fund sold about $500 million of assets at 94 cents on the US dollar at the time when investors have grown increasingly concerned about the risk underlying the $1.8 trillion market, the private credit market. Well, it's bigger than that. So this is a contagion. It ain't just BlackRock. It's Blue Owl, Blackstone. It's numerous companies, numerous investment managers. So what is private credit? If I didn't already explain it properly, and if you're like me and you're a visual person, private credit means it's a loans made by private debit funds, asset managers, insurance firms. Basically, they fund private businesses that are not in the stock market. These loans are often direct lending to mid-sized companies or smaller companies. These loans are leveraged loans, buyout financing. With private credit, guys, there's a lot of leveraged. So leverage among leverage, you know. So it is quite heavily geared, as they would say. Rising defaults. Yeah, we've been having quite a bit of that. But of course, to them, it's not a big deal. Companies can't repay loans due to high interest rates and weak economic growth. Illiquidity. It's not as liquid as a public bond. But you get more return for that. Investor redemptions. If investors rush to withdraw, funds may gate withdrawals or be forced into fire sales. Guys, what I think this is a starting point, you know. This can affect all financial markets, crypto, stocks, everything. And nobody wants to talk about it. Very few people are talking about it. You know? I think something's coming, you know, and it's all during a war. And then this happens. All right, you know, during the New World Order, this transition to the new system, because they have to reset the system, right? This could be the contagion for that. So anyway, I think I'm going to end the video there. So hopefully you learn something. Protect yourself. Diversify. Don't put all your money in crypto. That's the main thing. Don't be one of those idiots that puts all their money in one freaking crypto. At least, you know, spread it out a little bit, you know. It's very important.
Just a little pullback with the shop.
Very important. And get some gold and silver, some physical gold and silver. I think that's important. I'd like to give a shout out to this lady. It's called World Affairs in Context. Check her out on YouTube. She taught me a lot of this content, so I want to share it to you. If you haven't already bought your crypto, do check out Caleb and Brown. I'll put a link in the description. You're more than welcome to use that. They're the best crypto exchange in the world. You get your own broker, and they'll take care of you, you know. Free to sign up. Anyway, I'm going to end it at there, guys. Thank you very much. Safe investing.